All right. Hello, everyone. Hope you guys are all doing well wherever you're at. We'll be getting started in a few minutes. Just give a bit of time for people to join. Thanks for everyone on time. We'll get started in 30 seconds, a minute at most. Awesome. Well, thanks everyone for joining us. Hope you guys are all doing well, having a great close to the year. As you guys know, today we'll be talking about staking in a multi-chain world. Lucas Otomuro, Head of Research here at IntoTheBlock, and today I'll be sharing with you some of my research and thoughts on staking. So the agenda for today, actually before that, as usual, we do have a couple of pointers. We will be recording the slides and the presentation. So if you're not able to stay the whole duration of it or want to share it afterwards, we encourage you to look in our YouTube page and you can find our presentation and the recording of it. As well, if you have any questions, I'll be keeping an eye here in my monitor at the Q&A and the chat. Please try to do questions if they're regarding a particular slide. If not, we'll also have a more extended Q&A session at the end. Okay, now let's dive into the agenda. First, I'll make sure everyone's up to speed in terms of what is proof of stake and staking in general, as well as some of the other consensus algorithms. Then we'll dive into liquid staking, which is a form of derivative that's been developed for staking to be more accessible. I'll share the details in a few minutes. And then we'll dive into the staking in the application layer for the decentralized applications and built on top of these ecosystems. And finally, the road ahead for staking in general. But first, a quick update about IntoTheBlock. We've announced a few partnerships in the past few weeks. Most notably, we're excited to launch in Decrypt, one of the most popular and read news sites in crypto. You can find us there in their price pages for Bitcoin, ETH, and all the other assets they support, as well as in Alt-Trading. We also recently launched Algorand Analytics. They're free to access for everyone. So even if you're not subscribed to IntoTheBlock, you get to access the full amount of analytics, over 150 of them, covering financial, network, ownership, exchanges, social, derivatives markets, as well as capital markets. All right, so without further ado, let's dive into consensus algorithms. So before proof of staking, as many will know, there was proof of work. So this was one of the main innovations behind Bitcoin, and it involves balancing incentives in a decentralized way without having to trust a third party. So before, it was pretty much impossible to have a decentralized money system because of what is known as Byzantine generals problem, through which you would essentially require someone to validate transactions to avoid double spending and keep a ledger. So the theory was initially that you would need a trusted third party to validate these transactions and not have anyone take control of the system, essentially. But the main innovation, well, one of the big innovations behind Bitcoin was Satoshi Nakamoto's proposal for proof of work, in which a system of decentralized machines validate transactions without having to trust anyone, but rather just having to commit resources to this network, validating the SHA-256 algorithm, and essentially solving cryptographic problems to verify these transactions in a decentralized way. I know it's a bit of jargon there, but in short, it's just a system to reward contributions in a decentralized network. And since then, crypto has gone a long way to some less serious applications as well, as this meme implies. But once Bitcoin proved it could be done, a lot of interest came into the space, and it fueled a lot of innovation and, of course, speculation, as typical in crypto markets. So now that has led to dozens of consensus algorithms in the base layer, so what we call L1, blockchains like Ethereum, Bitcoin, Cardano, etc., and over 100 different incentive systems that essentially try to replicate or get inspiration from what's done in the base layer and are modified for the application layer. And that leads us to proof of stake, which is essentially I would say the leading staking protocol, consensus algorithm, sorry. Right now, ETH is in the transition from proof of work to proof of stake, but once it does transition to proof of stake, I believe the aggregate market cap of proof of stake blockchains will be roughly as much as proof of work. I would suspect it if it ends up surpassing it. And essentially, a key difference between proof of work and proof of stake is that it does not require mining equipment. So instead of having these machines validate transactions, you have deposits that are on the native token in smart contracts that are deposited to validate transactions of the network in a decentralized way as well. So you have, instead of machines, you have capital securing the network. And this is a lot more accessible because typically you don't need to buy hardware. There's a few exceptions, like in Solana, where you do need a bit of hardware. But essentially, it allows anyone with tokens to deposit. I'll get a bit into the details of what the difference between one and another. I'll come a bit closer for the audio, maybe. See, a few people are saying there are some issues. And aside from being more accessible, it's significantly lower electricity consumption. So you guys might have heard of how Bitcoin consumes more electricity than several countries. Well, this proof of stake, in the case of Ethereum, it's expected to consume only 0.05% as much electricity in their ETH2 blockchain proof of stake versus the proof of work right now. But as I've been hinting towards, there are different implementations between the proof of stake protocols that we'll cover. One of the main variants to this proof of stake consensus algorithm is delegated proof of stake. This was one of the first applications of it was EOS, and essentially the way it works, the difference between proof of stake and delegated proof of stake is that it relies on delegates, as the name implies, and these can be either elected or assigned. So if they're elected, it's somewhat similar to representative democracy, you might think. If they're assigned, less so, and it can be a more autocratic. And in a way, because these transactions have to be validated by less people, just the delegates and not all the nodes and users, this reduces the costs, making it more scalable. But as you can imagine, it also makes it more centralized, since you end up relying on a few nodes rather than a myriad of user participating. So this creates the risks of cartels developing. And we saw that with EOS block producers, which of course didn't end up too well for the protocol. Another alternative to proof of stake is known as proof of authority, sometimes called proof of staked authority. And this is deployed by BSC, Binance Smart Chain. And it's quite similar to delegated proof of stake in terms that there's only a few entities that have to validate, in this case, their credentials. And so they're staking reputation rather than capital, even though there are slashing costs for these people. It's a lot more in a way of a Web2 process where people have their identities, their identified companies or individuals, and essentially there's also reputation cost for not keeping up your node and things like that. And it's a similar trade-off than regular proof of stake in terms that you're also having more scalability, but less decentralization. So I developed this short framework with some of the main elements that I've been discussing to compare across some of the largest smart contract platforms that use proof of stake variants. So ETH2, which we're transitioning towards in the Q2 of next year, is regular proof of stake. There are some validated requirements, so notably 32 ETH, which are also locked until the merge takes place. But there are liquid staking alternatives, which I'll dive into. This is highly decentralized because anyone can supply to these contracts. So right now, as of data from the ETH2 site, there are 269,000 validators. And another key characteristic that's becoming a main proposition in a way for fueling the value of the security of the underlying network is the fee burn mechanisms. And Ethereum has deployed with the EIP5059 a dynamic fee burn that ranges between 75% and 90%. I also have an article that dives in depth into all of this. In case you guys are interested, you can check it out on my Medium page. By comparison, BSC uses proof of stake authority, and as I mentioned, it's a lot more centralized. So only 21 validators that are pinpointed by the Binance team, really, even though they do have to have certain credentials. There is so far is no fee burn type, even though there are proposals to implement it. Then there is Solana, which uses a hybrid. So they essentially use proof of stake and an additional layer called proof of history, which takes care of a lot of the computation behind the consensus. So this makes the underlying consensus for proof of stake less, occupies a lot less data. So it's a lot more scalable and sacrificing less on decentralization than, for instance, BSC. So they have a lot more validators participating in consensus, and they have a 50% fixed burn rate. Then there's Avalanche, which have a higher validator requirement of 2,000 AVAX tokens, but still have a relatively high number of validators, 1,218. And there's 100% of the fees that are paid in Avalanche are burned. Then there's Algorand, which takes a bit more accessible approach with only 0.1 algo tokens to require to stake. So this makes it such that virtually any holder of algo, since it's valued $1 pretty much, can stake. For this reason and the verifiably random selection of nodes, they call it pure proof of stake. And there are currently 1,546. I believe it's the second or third highest number of validators. So it's incredibly centralized, and they don't have any fee burn. So I've been hinting to many of problems that are emerging here with proof of stake. One of them, of course, is that there are high minimum requirements. So of course, 32 ETH is not affordable for the average person right now if they want to participate in consensus. Then on the other side, there's also some hardware requirements. So Solana has significantly higher hardware requirements, so you can't just validate it on a regular laptop. You need a specialized laptop with very high GPU and memory capacity. So that's also another barrier to entry. Then there's the issue of these staking your tokens being illiquid. So you're not able to quickly sell them or do anything with that portion of liquidity that's allocated. So they're locked, and there are withdrawal times. Sometimes in some of these protocols, it can be a week or more to withdraw the tokens that you're staking. Of course, it varies protocol by protocol, but it's an issue nonetheless. And finally, they're not composable. So they're not leveraging the power of the applications being built on top of smart contracts. And the solution that has emerged for this is known as liquid staking. And they allow to unlock the liquidity, the utility, sorry, for these staking tokens solutions. So there is no minimum. You can stake in Lido Finance, which is the largest player. You can stake 0.001 ETH, I believe, and you have no withdrawal periods. Instead, what you do is you get staked ETH, the token ST ETH, to represent your funds that are deployed within Lido, and then they take care of staking it for you. And a major benefit that you get from this is that you're able to use your staked ETH tokens as a money ledger. So this is the metaphor that many of you might be familiar. Within DeFi, there's this cool application really that you're able to build on top of the existing innovations. So for instance, with staked ETH, you can now deposit that token into MakerDAO, and while you generate yield, you can also take a loan with it. So you're like simultaneously earning yield to repay your loan and getting extra cash that you can use for essentially whatever you want. And plenty more applications that are being built on top of staking. So under the hood, liquid staking similarly manages incentives through smart contracts, and it works with a set of validators. So here's the infrastructure diagram for how Lido Finance works. Essentially, the user deposits ETH into Lido's staking contracts. Lido then sends this to the ETH deposit contract, which is the one where funds are allocated to stake and get staking rewards prior to the merge. The user, in return, as I mentioned, obtains the staked ETH token, which is a derivative. And the Lido team under the hood works with validators that have their existing infrastructure and have a set of incentives to validate, essentially to stake for their users on behalf of users without the user having to have those tokens locked for until the merge, which of course is an issue, and also having the capacity to take smaller deposits. In return, the incentives for Lido and validators is that the users, 10% of the staking rewards go to Lido, and this is split 50-50, so 5%, 5% between the validators and the Lido protocol. And so even though it's a quite new concept, I believe they just started deploying it earlier this year, liquid staking has increased in relevance significantly throughout 2021. So it went from just 3% in January 2021 to currently, I believe, over 20%. So this really shows that there's demand to unlock this yield, and of course, a lot more utility that you can do with it, with liquid staking. And for Ethereum, the main player is Lido by far, with 80% of share. But there are other smaller protocols that have also their own solutions to staking. More recently, I believe Rocket Pool also launched, which is a more decentralized approach to it. You guys can dive into the details, but it's out of the scope for today. And of course, it's not just happening in Ethereum. So as we've transitioned to other blockchains, getting traction and getting a lot of applications building on top of them, a lot of these ideas are being replicated and, of course, adding their own touches in different blockchains. So one of the first was Terra with Lido. I believe it's called bTerra, the derivative for staking Terra in Lido. Staking, yeah, Terra through Lido in the Terra blockchain. There's also in Solana, there's also Marinade within Solana doing this, and Lido will also soon launch in Polygon. And then there is Stake, which is a protocol that's currently about to launch for the Cosmos Hub. So of course Terra is part of the Cosmos Hub, but now every blockchain created through Tendermint, the Cosmos-based blockchain building layer, will be able to have their staking derivatives. So I would say it's still in the early stages, even for Ethereum, but more so for these other chains. So for context, staking, proof of stake has been in development since 2015 or so. Vitalik proposed it way before it was just theoretical back then, and I believe the Ethereum network had been live for a few months, and they were already proposing proof of stake. And through all of this research, a lot of the applications being built started to find their ways that they could replicate these incentive systems to themselves promote growth within their protocols. So one of the first few applications to do this was the Synthetics protocol, the derivatives application. And so they launched staking in 2019, which was a system in their protocol through which essentially users would deposit SNX, their native token, and get rewards both in inflation, so issuance of SNX, as well as rewards from fees that are generated by the system. So essentially, this allowed the SNX liquidity in Synthetics to be used for derivatives contracts, they call them synths, and create greater liquidity within their system for a more robust trading engine. And now, based on these early applications, the growth of staking has grown ridiculously, with many different versions of them growing through 2020 and 2021. So one of the main questions that I get asked from people that are entering the space or are starting to get curious about it is what's the difference between all of these terms? So they get thrown around interchangeably sometimes. It can make it confusing for those that are new in the space. But I would clarify these terms the following way. Yield farming, which is also the same as liquidity mining, is essentially the concept of depositing liquidity and earning tokens in reward. So this is essentially inflation for rewarding your liquidity that is used in their systems. A good example, a notable example of that is Compound with the Comp token, where you deposit into their protocol liquidity or borrow, and you earn Comp tokens for adding to their service, to their protocol. Similarly, PancakeSwap, you receive the Cake token if you deposit liquidity into their protocol, into their DEX. Then there's staking. We're going to give us a copy of the slides for those asking. Then there is staking, which I sort of described with Synthetics as an example, but it's essentially also depositing liquidity and earning both fees and inflation. In some cases, it's just fees, and in some cases, it's both. A good example of this is the Curve VE-CRV, where you get also voting power that grows depending on the amount of time that you've locked your tokens, and XSushi, in which you just earn trading fees, so 0.05% of the trading fees, the trading volume, go to XSushi stakers. Finally, there's liquidity providing, which is more simple. We call it LP in crypto for short. It's just depositing into a pool of assets, so it's rather than just one asset, it's really depositing liquidity into both sides and earning fees from the revenue. So, and a good example is if you deposit Bitcoin and ETH into Uniswap, you get trading fees from traders that are using these pools. A similar concept is what is known as Pool 2 that works along with these concepts that I've been describing. So essentially, it consists of having a liquidity mining pool where you earn, for instance, in the example of a PancakeSwap, you deposit, let's say, Bitcoin and BNB into PancakeSwap. You earn Cake And then that cake you can deposit into a staking pool to earn more more APY on top of the rewards. So it's sort of like a reward on top of your reward. It can sometimes get dangerous because it relies on you locking your rewards for more, and there's a lot of criticism of people taking advantage of that. But it's essentially the game theory to incentivize liquidity and rewards for depositors. So I know it can get confusing, but that's sort of my base framework to understand these. Another thing that we're seeing in the application layer is building on top of staking. So one of the main protocols pushing this forward is Abracadabra, the protocol behind the stablecoin MIM, Magic Internet Money. And what they are doing is that it's a lending protocol, somewhat similar to MakerDAO, but you're able to deposit staking tokens to borrow against. So you can deposit, for instance, your pool in Curve that has staked ETH. So this is a pool that earns interest from both the staking ETH, from Lido, the LDO token, and from CRV liquidity mining in Curve, and you're able to borrow with that. So you can see why they call it DeFi Legos, money Legos, because you can essentially do a lot with those underlying primitives and borrow against it. You can also see it with XSushi, which was I was just explaining. Okay, so now last part. How is staking expected to develop over the next few years? Well, in the near term, the next upcoming catalyst is the ETH 2.0 staking. So even though it's already live, the proof of stake chain, the beacon chain, it's still not processing any applications. So we're expected to have the merge of both the proof of work chain and the proof of stake chain to take place in Q2 of 2021. So all the applications will now be running on top of the POS chain, and no more mining, no more proof of work, no more electricity consumption. Also, no changes in fees, unfortunately, for layer 1. For lower fees, you will have to look at layer 2 until sharding, at least. Regardless, we've seen a lot of value going into the staking. So the staking contract currently has approximately $32 billion in it, which is, I think it's 8.6 million ETH, about 8% of the supply. What will change, however, it's not fees, it's the APYs, that the return that stakers get once the merge occurs. So in one of my articles that I mentioned on ETH 2.0, I run the numbers, which you see here, for how this is expected to affect the rewards generated by staking ETH. So now, in current state, proof of work fees, so transaction fees, go to miners. Where once the merge takes place, transaction fees will start going to stakers. And so this leads to the natural growth in the APRs that stakers are going to get. So based on my calculations, it's expected to double from about 5% now to anywhere between 10 to 12%. Another thing that's a bit further down the line, but we're starting to see the early developments for, is cross-chain staking. So what I mean by that, of course, the staking itself will occur in the base layer that you're using, but the liquid staking can go cross-chain. And we're starting to see that with Lido's BETH position derivative token in Terra. You're able to earn yield on top of ETH in Terra, just as if we were staking. And with the Cosmos inter-blockchain communication and the P-Stake protocol that I mentioned, you should be able to stake in the near future your tokens in these blockchains and move them across each other. So you're able to generate yield and leverage the money Legos in other blockchains as well. And a few crazier ideas down the line sort of have to do with the way I personally, and some people within the crypto ecosystem see staking. So smart contract platforms, as many will know, support a myriad of use cases from finance to art to domain systems and many more. So they're sort of becoming new economies. Some compare it to nation states themselves. And as I described before, the fees that are generated by these systems will start now going to those that are staking. So in a way, you're earning part of the GDP that is generated by these networks, if you so call them, as can compare them as network states, as Balaji Srinivasan calls them. So what this allows is people all over the world in a decentralized way to earn yield from all the networks you participate in and add value to. And here you can see a vision where essentially anyone that contributes to a network, even if you're a user or a supply side party, you can generate benefits and own part of the networks that you work with. So in conclusion, staking is a critical piece for Web3, for the centralized internet, smart contract platforms, and everything that I believe is yet to come. Incentive systems, staking is essentially a set of incentive systems to ensure security for L1, but also to encourage growth in the case of decentralized applications, and also for layer ones. Liquid staking is unlocking capabilities. So now you're not having to be subject to the constraints of not having a minimum or having withdrawal periods. Liquid staking is able to unlock this for anyone that deposits, as well as being able to build on top of these liquid staking derivatives. And finally, I think there's a lot of potential within this, as cliche as it sounds. Endless possibilities, and I hope you guys are excited as I am, because there's a lot of interesting and exciting work being built on top of staking. Thanks everyone. Make sure to sign up for our next webinar. We're taking a bit of a break for the vacations. Hope the holidays, hope you guys are too. But our next webinar is going to be on the growth and opportunities within crypto derivatives, one of the fastest growing and most exciting spaces within crypto. So make sure to sign up. Our team will be sharing the link right there in the chat. Thanks for sharing it, guys, and make sure to register for the next one. I'll be sticking around 10 minutes or so for some questions. Okay, so Bill here is asking, any insight into third-party collateral risk inherent in staking or DeFi in general? So it depends. It depends if you're talking about staking in the base layer or in the application layer. In the base layer, there is no third-party risk if you're staking it yourself. It's non-custodial. If you're using a validator, yes, there's some third-party risk, even though they have their own credentials. There's a third-party risk because you're delegating your stake for them to stake on your behalf. And in the application layer, it depends on how decentralized the protocol is. So yeah, the answer is really it depends, and make sure to do your own research, because you don't want to stake into a contract where there's a backdoor that a protocol can access, which doesn't happen too often, but it can. So make sure to do your research. Let's see a few more questions here. Do you think that proof of work will be totally replaced by proof of stake in the future? To be honest, I don't think it will, not fully. I think we'll go to a future where proof of stake is the leading consensus algorithm, and that the market cap of proof of stake blockchains will surpass that of proof of work blockchains. I believe Bitcoin is likely to stick around with proof of work just because of the ethos of decentralization and also of not changing. Um, Reason I'll go a bit into more detail. Proof of stake, yes, can be more environmentally friendly and potentially more secure, but proof of work does lead to a bit more natural selling distribution of the tokens. So it's one of the main arguments, which is not full. There's no direct conclusion on whether it does end up being more decentralized or not. But I know that a lot of Bitcoiners certainly feel that way. So I think it's unlikely that Bitcoin will transition to proof of work. But I think that nonetheless that POS will overtake proof of work as a major one. In terms of risk payoff, what's your position on the inflation cost through staking versus the benefits for layer 2? As staking dampens, staking. Okay, so inflation, I believe, is a natural part of stimulation in economies. Of course, it can get a bit ahead of itself, as we're seeing in the US more recently, but it does help incentivize the economy. So even though you can get diluted, which is essentially what inflation does, it does play a role in having the incentives for within POS for security. So it would be hard to rely just on transactions fees for security. But what I think systems are doing instead is offsetting that inflation with a supply burn mechanism, which is no doubt why they're becoming so popular, is that essentially you have incentives in to grow the system, but then from the actual usage and demand, you end up reducing supply as well. So it becomes a system that balances itself automatically. I have a question of some see staking as a Ponzi scheme. How do you prove against it? Yes, I've heard this, and certainly with some of the Olympus DAO forks, it can appear as if it were a Ponzi. Where you get like thousands of percent APY to stake, and yeah, it does rely a lot of the smaller protocols. I'm not saying about Ethereum or the noteworthy DeFi protocols. They somewhat rely on more people getting in. Still does not necessarily make it a Ponzi, but it's also like I think one factor that everyone should understand is where the yield is coming from. If it's just from continuous inflation, then you need to make sure that there's there's systems on the other side of the equation, as I was explaining, such that the inflation doesn't end up in everyone getting diluted and being poor. You also want to have a balance of supply and demand. And I think against a lot of Olympus DAO is proven to do that in a way with 1,000% APY. That's just personal opinion. But some other protocols that are just like continuous inflation and issuance of token without too much future foresight on how to balance supply and demand, then yeah, it can sort of be more like a Ponzi. So in short, make sure to do your own research and know where the yield is coming from. Can you go into detail on why ETH 2.0 will have no impact on transaction fees? Would you anticipate gas fees being reduced after the conversion? Yeah, so no, it's a common misconception. There's multiple parts, multiple stages to ETH2. We already did the launch of Beacon Chain, which was known as Phase 0. The next step is the merge, and what that will do is the merge of the proof of stake chain and the proof of work chain. The proof of stake chain, however, is expected to have the same fee system as the proof of work chain now. While it does get rid of the energy requirements from miners, the fees for transactions continue to be the same. I believe until sharding is done, which sharding essentially is like a blockchain of blockchains. So you have several interconnected blockchains. Until that is done, the transactions per second, so the throughput, as well as the fees, are expected to remain the same for users. What Ethereum is doing near term before that is to get more prominence through layer 2 scaling. So Arbitrum, Optimism, Polygon, which is a sort of sidechain, but now they're doing CK rollups. So there's a lot of solutions near term to help with fees, but the merge is not one of them. Okay, last few questions. Where can I read more in-depth material related to what you have presented? Apologies for self-promoting, but I do have some Medium articles diving into the ETH 2.0 staking as well as Algorand staking. There's good resources in there in our Medium. Last question, APR for staking currently about 5.3%, 4.9% on Lido. How do you think this will change in the future? Is it correlated with ETH USD price, or what are the drivers of APR? No, so the APR itself is denominated in ETH, or the native token of whichever asset you're staking. So essentially, if you deposit 1 ETH at 4.9%, well, 5.3 you're doing directly, you get 0.053 ETH, regardless of the price of ETH. So if ETH is $10,000 or $1,000, you still end up with 1.053 ETH. And what affects this is the number of validators that are staking. So I have a good slide on this. So the parameters affecting these APRs, in the case of Ethereum in particular, is the amount of ETH staked. So this amount varies, but essentially the more ETH that's staked, the less the reward is. So these are my calculations based on the 7-day, 30-day, and 90-day growth. So based on the 90-day growth, I project 10.68 million ETH to be staked in the staking contract. And also depends on the fees that are getting processed. So as I mentioned, transaction fees will go from going to the miners to the stakers now. And so now the more transaction activity there is, the higher the APR will be for those staking. But it also depends on the fee burn. So the percentage that is burnt varies depending on the congestion of the network. I won't get into the full details of it. But essentially, the more that is burned, the less that goes to stakers. But it also ends up being like a indirect dividend since there's less supply. So I hope that answers your questions. Thanks everyone for coming here, and hope you guys all have a great end of the year. Bye now.